Hello, good evening, ladies and gentlemen. It's a pleasure to have two investing stalwarts with us who will help us explore the question, how do you arrive at a CEO multiple? Prashant, you're a fund manager and you have, over the years, you have met several CEOs, enough to write a book, I am assuming. But can you tell us what are those leadership qualities or, traits which don't get adequately captured in the numbers?
I think the answer to that, to my mind, foremost is whether the company's competitive advantages are increasing or decreasing. I mean, it's possible to deliver near-term earnings while compromising on longer-term sustainability and vice versa. So I think analysts and numbers do not do justice to these two.
Anything specific to the leadership? When you say market competitive,
Yes.
it's a business variable. But when it comes to CEO, how do you really capture that?
So analysts could fail in assessing if CEO is taking steps to enhance the longer-term competitive advantages. It could adversely impact earnings. And markets and analysts often fail to appreciate that, and vice versa.
So is there a honeymoon period that you have where you trust the CEO for a quarter, 2 quarters, 3 quarters, and then kind of,
No, it could go
re-rate
on.
the multiple or
It could
derate
go
the
on
multiple?
even for a few years, but eventually it will begin to show up in the numbers either way.
Devina, you have been very articulate and you keep saying that, ROC is what you see as, one metric that clearly shows out where a CEO stands. But is there but do investors tend to underestimate the leadership behind it? Because ROC, I would say that it's return on CEO first and then the return on capital employed later.
It is actually the return on the business first. So if you look at, one of the Warren Buffett quotes I agree with is that when a good management takes over a bad business, it is the reputation of the business that is likely to continue. So if the business is inherently poor, unless you can change it, for whether it is poor in terms of returns or in terms of prospects, or it could be better like ITC we spoke about. So over a period of time, it has become a different company. CRISIL used to be 100% ratings, and now I see the revenue is 28% from ratings, so, which is again a process that started a couple of decades ago. Internationally, Pepsi transformed itself from a sugary drink to a much broader business. But overall, in terms of what a CEO can do is to some extent constrained by the business. And one quality of the CEO which is probably not captured, at least in short-term numbers, is the long-term perspective. And I would say, for want of a better word, the integrity part. So like if I talk of financial services, as a banker or even an asset manager, you can take the short-term perspective and say that I want to maximize fees by recommending products which may not be great for the clients or the investors. And it will show up poorly in your numbers. But that, to my mind, may be the right thing to do. Or if you look at internationally, if you see most mergers and acquisitions give you a short-term share price, but by a vast majority, most of them are not value accretive in the long term. So that's definitely a CEO decision most of the time.
Okay. Prashant, in India, maximum lot of listed business are promoter owned. And, the CEO tends to be the promoter. So is that over the years, have you seen a distinct shift in the way a promoter CEO kind of runs the business versus a professional CEO? And has that changed over the years from what it was maybe in the early 2000s and now?
To my mind, an evolved promoter CEO is the best CEO to have. I mean, an evolved CEO, an owner CEO is someone who understands his capabilities and weaknesses the best, and he will bring in professionals to complement that. But I don't think it would be right to generalize. There are exceptionally managed, professionally managed companies, HDFC, L&T, even ITC, I would say, would figure in that. And on the other hand, there are companies which have done exceptionally well, who are promoter driven, and there are companies which have not done so well. I think there is a third breed of companies which is now coming around, and which is what we need to evaluate carefully. There are a large number of companies that are backed or predominantly owned by PEs, private equity, and the founders or the owners have minuscule stakes. So what happens to these companies when the PEs sell out completely and there's virtually no skin in the game? Will they shape up as some of the very well run professionally managed companies, or will they flounder? I think that would be an interesting outcome for someone like me to watch.
I would just like to add something to that, that 25 years ago when I started covering the US and other European companies, what stood out was that they were almost all professionally run. Whereas now, if you look at the large market cap companies, a lot of them are founder run. So again, the market cap there also has moved very much to founder run companies. So it's not a one-way street.
Prashant, you mentioned about this new age companies, but the market, the street seems to be fascinated by new age companies, the founders, the way they speak and when they articulate. So today you're seeing the kind of multiples that an food delivery company has is much way too high to compare to a high ROC paints company. Yet it seems that the market is more enamored by the young startup managers. So what is this obsession by the street that it tends to, I would say, focus more on the personality than the predictability of earnings?
See, one, I don't think the PE multiple is a function of ROC alone. A good business, a decent ROC is certainly necessary for a sustainability of a business and to be richly valued. But I think the market, the PE multiple is more a function of the longer term sustainable growth, which comes from the TAM, the total addressable market, your comparative position, the business cycle you are in, the stage of growth. There are so many things. And I think the customer is clearly moving to the way we are engaging with businesses, the way services are being delivered. So I think first movers in some of these areas will definitely build up very good, very sustainable businesses. So I would say in some cases, the startups are rightly valued, and in many cases, I feel they are excessively valued. But this is not new. I mean, excesses and narrative-driven investing, they've always gone hand in hand, whether it was 92, 2000, 2008, and we see excesses in these markets as well.
Devina, you have been kind of very early on looking at global investing and companies, and one name that stands out is Unilever's CEO, Paul Mann, who was brave enough to say that I will no longer give quarterly guidance. And during his decade, he delivered a 290% shareholder return. Today, do you think CEOs can be bold enough, at least in the Indian context, to say that, I will not make these quarterly predictions and, and focus on more the long-term story? Well, and will the markets like it, and will you kind of back a CEO who says that?
So many companies don't necessarily give quarterly guidance. So that is not as ingrained here. And remember, Unilever is not an American company. So also this whole aura, I mean, probably this is the wrong place to say it and it won't win me many friends. But the fact is that this whole aura of that only the CEO is responsible for the performance of the company, this is also a very American narrative. So if you look at the CEO compensation also, in 50 years back, it used to be the CEO's compensation was 25 times the median worker compensation in the US. It is now in various estimates for Fortune 500 companies, it is 200 to 280 times. In Europe, it is still about half that number. I think it's about 100 times. So, so again, America, it's become a little crazy because it is that if you miss the earning estimates by 1 cent, the price of even a large, well-traded company can fall 30% in a day. So it's become a little nonsensical. But as I said, the entire burden of either the positive or the negative performance is not on the CEO. There, obviously, that's the hand that guides, but there's also the realities of the business and of the marketplace. And of course, ideally, you do want a CEO who concentrates on the long term. I mean, that's what you're there for.
I think we are running short of time. It's moving faster than, shrinking faster than the EBITDA margins. But one last question before we wrap up. If hypothetically, if you have to step in as a CEO today, would you become a CEO of a DTH company which is navigating rapid disruption, an FMCG leader high on ROC but facing intense competition, a new age startup scaling fast but loss-making, or a public sector giant which is rich in scale but limited in flexibility? Prashant, your team. And why?
None of the above. I only know
You are
investing,
happy
and I
being an
would
investor.
stick to
So
that.
you're saying a CEO's job is tough. Devina?
Probably the easier ask will be in the FMCG company. I would think that even if you're facing competition, you have the flexibility and probably money to do things. The second would be the DTH.
Thank you, Devina. Thank you, Prashant, for that interesting insight.